rising interest rates in the build up to that, a very different interest rate scenario, and that inflicted a lot of financial pain. So I think for short-term relief, the Reserve Bank probably did the right thing.
What has been the impact of COVID-19 and the lockdown on South Africa's property market? Well, joining me to discuss is John Loos, who's a property economist at FNB. John, let's look at the residential space first of all. What was the impact not only of the pandemic, but also the decision by the Reserve Bank to lower interest rates last year?
Well, it's interesting, David, on the residential side, you see more of a sensitivity to interest rates often than the economy. So you had a very deep recession, quite a lot of job loss too, and quite a lot of financial pressure on many households, you would think. But yet we've had this flurry of demand in the home buying market, driven not so much by economic fundamentals, but more by this aggressive cuts in interest rates of the Reserve Bank last year. A lot of aspirant home buyers, there's a culture of home ownership or wanting to own homes in South Africa. And so you tend to find that the focus is very much on interest rates and the installment repayment, obviously for those that still keep their jobs. So in the home buying market, not the rental market, that's very weak, but the home buying market has been relatively strong, credit driven, taking advantage of low interest rates. And so almost some would say out of line with economic fundamentals, minus 7% drop in GDP, very weak economy, but yet this rather solid residential demand, which looks a little bit out of place, I would guess.
If you're enjoying this content, click here for a 30-day free trial of the Center for Risk Analysis to access exclusive client webinars and reports.
So John, we've discussed the residential space. What about the commercial property space? What has been the impact there?
Commercial space is more, I guess you could call it possibly a more rational market. I don't like to use that word, but perhaps the commercial property is very much driven more by the economy than by interest rates. And so you've seen a very weak commercial property market. The industrial one of the main categories of commercial property, the most solid one is probably industrial property, driven by optimism of the need for warehousing and logistics space with the emergence of online retail to a greater degree. So that's done relatively well. And that's probably the most affordable of the main property categories. But when one looks at retail, that's been battling. A lot of retailers got shut down in the hard lockdowns and tenant performance was particularly bad there. So that's been battling its way back out of the hard lockdowns. And then the office property market, that's got an interesting problem. The tenant population hasn't been too financially stressed, but we've had this forced lockdown experiment, quite successful too, I may add. And so according to our property brokers surveys, the office market is the weakest of the three big commercial property sectors, with a lot of the tenants the office, the companies that occupy office space, be it owners or tenants, revising their office space needs, looking at a greater portion or a greater amount of work from home, either part-time or full-time work from home. And then, of course, the finance, real estate, and business services sectors has lost quite a lot of labor. Employment numbers have gone down by 7%. So it's not only about the greater levels of work from home, but less office space required because of retrenching and job loss too. And so the office market looks to be in a particularly bad way, rising national vacancy rates, and the weakest of the three major property sectors. If you look at minor sectors as well, you would put the hotel sector probably at the top of the list of weakness. But just looking at the three major sectors, it seems to be the office sector that's the weak link.
John, do you think that the decision by the Reserve Bank to aggressively lower interest rates was the correct one, given the context of the time?
Well, I think that it's probably, when you get into a crisis, what else do you do? And I think that it was probably appropriate at the time. It's provided a massive cushion for both businesses who are indebted and for households. If the global financial crisis, if you look at the household sector financial pain, the recession wasn't nearly as deep as what this last year's one was. Back in 2008, 2009, but you had 5 percentage points worth of rising interest rates in the build up to that, a very different interest rate scenario, and that inflicted a lot of financial pain. So I think for short-term relief, the Reserve Bank probably did the right thing. The risk is that you get into some sort of housing bubble. Now, that doesn't, housing bubble where speculators start climbing into a strong housing market and, riding a strong house price growth trend using very cheap credit and, trying to make quick capital gains, buying and selling properties in relatively quick succession. So that's always the risk, is that you get into a speculative bubble in the housing market. And certainly, although there hasn't been talk of that here yet, and if you look at house price growth, it's hardly a trend that's worth riding for speculators yet. FNB's house price index still, 3-4% year-on-year growth. That's not exciting. But certainly in other countries of the world where there have also been aggressive interest rate cuts and quantitative easing and relief packages, stimulus packages, there have been mounting concerns of housing bubbles. Strong price growth in New Zealand, and the Prime Minister not so long ago in New Zealand instructing the central bank, from what I've understand, to look not only at inflation targeting, but to look at house price inflation too, and to, if necessary, take action to cool that off. That's not a bad idea if you get to that, because housing bubbles, when they do occur, can put quite a lot of, can impose, financial sector risk through, piling up the cheap credits, the mortgage credits. So they do need to be watched. But I don't think that South Africa's, although I say that the residential market is somewhat out of line with very weak economic fundamentals, I don't think that it's a wildly speculative market by any stretch of imagination at the moment.
Thanks very much, John. Let us know your thoughts in the comments section below. What will be the impact of the lower interest rate environment on the property sector? My name is David Ansara. This is the Center for Risk Analysis. Until next time, take care.